Ladies and gentlemen, we have a jam-packed video here. We're going to talk about the Fed speak, Jackson Hole meeting, my thoughts on the outcome of what could come for the first rate cut. We're also going to talk about some undervalued stocks that are positioned extremely well, whether we go into a recession or not. These are stocks that I'm personally looking at. This is not financial advice, and hopefully you guys enjoy, and let's get into it. Just when you think the market can't get any more expensive, the Fed signal a rate cut, and what happens? The market gets even more expensive. And with every great bull market comes a tragic end to that bull market. In my opinion, 2025 is going to be no different.
While the task is not complete, we have made a good deal of progress toward that outcome. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased.
So with the Jackson Hole speech coming out pretty dovish and signaling rate cuts, well, you know euphoric is now in play here. And this is usually the late stage of a bull market, the euphoric stage, the stage where nothing can go wrong and valuation really doesn't matter. But if you're subscribed to the channel, guys, you know that everything comes down to valuation. But as most of you know, what I believe is going to take place here is we're going to hit the euphoric stage, take out the new highs, probably get pretty darn close to 6,000 in this market, just like what happened in 2007, right after the first rate cut. But then we have to start asking ourselves some questions. Why are the Feds cutting rates? And what's really going on with the economy? We're seeing that company bankruptcies are now starting to skyrocket. 7% increase, totaling 40,267 bankruptcies. And when we compare that to commercial Chapter 11 filings that are up 70%, small businesses are having some big problems. What is wrong with small businesses having big problems? The American economy is built off of small and medium-sized businesses. As much as we follow these tech companies, they're really not the driver of the true economy. We're also starting to notice some corrections in the labor markets here. The job market's not looking as strong as we all initially thought, and if you've been subscribed to the channel, guys, I've been pointing this out with all the bankruptcies taking place, and the fact that the job market is relying on three major factors. Number one is going to be services, number two is government, and number three is healthcare, all which we can kind of prop up with the consumer out there spending. But once that consumer stops spending, this labor market is completely shut down, and I'm talking about overnight. So we pile up all the bankruptcies that have taken place with small and medium-sized businesses, a consumer slowing down. This is not strength into a labor market. And while the Fed is signaling a 25 to maybe a 50 basis rate cut, at this point in time, I think the Feds are doing a little too little, a little too late. With labor markets around 3.4 to 3.5% unemployment, now shooting up to 4.3% unemployment, and we're seeing the revisement in non-farm payrolls, signaling that there's probably going to be a little bit more downside risk here when it comes to unemployment. Every single time, ladies and gentlemen, this plays out the same. We get yields normalize. That puts the top in the market. A lot of people think the inversion causes a recession. That's not what happens. But I think it's coming to a catastrophic end very, very soon. As most of you know, end of 25 is what I've been projecting. Could happen a little bit sooner here. I definitely think there could be an argument we could be in a recession by the end of this year to the beginning of next year. But we won't get that confirmation until 6 or 7 months while being in the recession, unfortunately. We really don't know the lag effects of monetary policy. We've had a substantial rate hike, but these rate cuts are going to be slow and steady, which to me is going to be death by 1,000 paper cuts. We've already seen small businesses roll over. Manufacturing's been in recession for 13 plus months. Real estate's been in some sort of recession. Commercial real estate's definitely been in a deep recession. And so aspects of the economy have definitely been in recession. But the one thing that's propped everything up is the fact that the consumer had a very, very strong balance sheet going into this tightening cycle. So I did stumble on a stock that I find very, very interesting that I want to share with everybody. And as most of you know, this is a value channel, so we talk through the fundamentals and long-term price action. Now, this stock hit a pandemic low around $6 a share. Well, because the globe was shut down, spiked to over $70 a share and is now trading around $28 a share. Obviously, with this type of price action, you have to have a strong stomach, and you also have to know exactly what is taking place, why the price is so volatile, because this is going to be a commodity-driven stock. And the stock I'm talking about is Mosaic. They specialize in fertilizer, specifically on the chemical side with phosphate and potash. Very, very interesting company when I think about long term. And when you talk about their mission being able to help the world grow the food that it needs, pretty strong mission behind that, and also pretty strong moat as they are one of the largest producers globally for fertilizer. Now, the reason why I like this stock, to me, it's almost like emerging market play. As the emerging markets grow, this should be a company that benefits that, as they do have some pretty good exposure to some interesting countries. And as population grows and we are more reliant on domestic fertilization, this company should be positioned extremely well. And the reason why I believe we're going to be more reliant on domestic fertilization is the global tension that's taking place. Now, everything that I just stated is speculation of growth in the future. These are not true numbers. These are just my opinions. But what I want to focus on is the opportunity I think this company has and how many tailwinds are actually going to grow free cash flow, I believe, for this company. The first thing I want to point out is the company is growing, but with commodities, it is very, very volatile, very up and down. We could be talking about 20, 30% move in commodity prices, which completely impacts what the company is doing as far as bottom line growth goes. We saw a huge spike in 2022, and that was basically coming out of COVID, one of their worst years ever. In 2020, earnings were negative. We were shut down. We saw a high demand for their products coming out of COVID, and now we're starting to see a normalization of what I believe we could predict maybe single-digit growth off of these levels, and I'm going to explain why that is. Now, even with the crazy volatility of this company, they've been fiscally responsible. They've been paying dividends for 12 years. They've been growing those dividends for 5 years. And the other thing is they've been buying back stock, going from 379 shares to now 325 shares outstanding. So buying back stock, returning capital in the form of a dividend. And I think they're positioned uniquely, trading at 10 times forward earnings, which could be a little bit off here. We're going to run our analysis here in a second. So when I run analysis, it comes down to a fundamental analysis for me personally. That's the most important thing. But the first thing I always like to look at is price action, because if something's in a downtrend, it's usually a momentum move, and it's very, very hard for it to get out of a downtrend unless if there's some sort of bottom formulating or some sort of catalyst to kind of get it out of the downtrend. So while price action has been pretty vicious on this one, going from $70 a share down to $28 a share, I do believe we're starting to see a bottom formulating here. We've hit this bottom multiple times. We're still creating lower highs and lower lows. But what I want to point out is we almost have a head and shoulders pattern kind of formulating here. We need confirmation of that first, but we have a left shoulder here, the head's right here, and hopefully we're going to form the right shoulder here. My fundamental analysis tells me that it's probably not going to go much below $26 a share unless there's something catastrophic happens. The thing I want to point out here is it did break above some of its major moving averages. And it's starting to, and it looks like it's starting to approach the 100-day moving average, which to me is possibly the most important moving average here. As we can see, it's been rejected 1, 2, 3, 4 times from the 100-day moving average. This has been the true resistance that I see. But the fact that we're getting a signal that it's breaking above the 10-day and the 50-day moving average is the start of possibly a reversal here, a reversal from a bearish to bullish pattern and some sort of bottom in that process that we could be seeing taking place here. Now, with all that being said, there is some headwinds with this company. The company showed a net loss of $162 million, but this was a reflection of the after-tax impact of a notable item totaling $334 million, and mainly foreign currency transactions. And this is where I want you guys to stay focused, is going to be the foreign currency transactions here, because as the dollar's weakening, I believe this is a very strong tailwind for this company. With all that being said, they were still able to free cash flow $183 million in one of the more down years that it's had over the last few years. They're also completing construction in Brazil, and they're making progress on their cost reduction plans that has been achieved over 1/3 of its target for a $150 million run rate compared to 2023 baseline. So we're seeing cost savings plans, they're growing, and we have a weakening dollar. So multiple tailwinds that I can see strong earnings growth coming out of this company. And as we highlighted earlier, just looking over the financials, Mosaic has returned $298 million of capital to shareholders in the first 6 months of 2024. And that's including share repurchasing, which is totaling $160 million. So they're buying their stock back at a pretty depressed price, which I really, really like. The worst thing to see is when you see companies buying prices at the 52-week highs and not the 52-week lows. Now, the volume is still there, but their average sale prices are coming down, which is impacting margins. But when we talk about commodities, this is going to be normal. You're going to see some years where the margins are very slim or possibly even negative, and some years where the margins are extremely fat and very, very strong free cash flow. And so what you want to see is a company that's fiscally responsible, that can handle the ups and downs of those cyclical turns. So we can see here that sales volumes are kind of staying flat, but what's the big problem here is the prices are coming down. But what they're guiding for is, we've already know that they're guiding for cost reductions, which should really help with margins, even if sale prices are coming down. Then we have a weakening dollar, so any business being done overseas should help with margin expansion as well. But what we're seeing here is sales volume for the quarter. What they're projecting out is sales volume in the third quarter are projected to be 1.7 to 1.9. So they're actually going to be probably closer to that higher end that we see here. The other thing I want you guys to think about is fuel costs. Fuel costs of transport, fuel costs to work on these chemicals. Fuel costs are coming down. That should be another tailwind for possible better margins. A big hit to them was definitely the Chinese phosphate exports declining 27%. That's a huge, huge decline. But 2024 long-term outlook remains favorable as domestic and industrial needs will continue to prioritize over fertilizer exports in the long term. So they're saying that in the short term, they're dealing with some headwinds, but in the long term, they feel like their business is very intact. And so this is where we have to start looking at price versus the value. Price is what we pay, value is what we're getting. If they're doing a cost savings plan, if the dollar is weakening, if energy costs are coming down, and the market's remaining tight for them, meaning that there's still a lot of demand, and they have exposure to emerging markets that are growing, there's multiple tailwinds that I see for this company. But as we saw by price action, this is a very, very volatile stock. This is not a stock for everybody. The nice thing is it does pay nearly a 3% dividend to kind of offset some volatility. But with this type of price action, it's not even going to be close to offsetting the majority of the volatility here. Now, we have to remember we're coming out of a high commodity prices here. We all know inflation has eroded us, but think about a company that's able to get through this. And this is a company that is able to get through this and is actually growing. They're expanding through hard times. And I really, really like that, because when we get a normalized market, it's going to catch the market off guard on how strong the earnings could be for this company. So we can see here they've done $412 million in free cash flow, almost $900 million in free cash flow, $2.6 billion in free cash flow, $1 billion in free cash flow, and they're on pace to do right around $500 million of free cash flow in 2024. So when I look at the free cash flow, I see that the debt and the balance sheet is not that bad here. Could it be a little bit better? Yes, but they also could be in a position, the free cash flow closer to maybe $1 billion to maybe $1.5 billion once we get more normalized here. So that tells me that the balance sheet could be very, very strong. So here's what I'm projecting out here. I'm projecting they're going to do right around $11.6 billion, and they're going to grow right around 3 to 4% going forward with the cost saving structure and the fact that we're in some sort of global recession here. And I think over the next 3 to 4 years, we could be out of it. We could actually see a lot of expansion taking place, more emerging market expansion, and they're exposed to those emerging markets that I like. And so I'm not projecting anything crazy out. I'm projecting out 3%, 4%, 3% with a big hit coming in 2025 of only doing $11.6 billion of revenue. Now they're on pace to do right around $12 billion, but I still think 2025 could be a transition year where things are still slow economically. And so I'm really erring on caution with this company, but I do think they'll get back to right around 12 to 12.5 billion in top line revenue. And I think they'll consistently grow that in the low single digits. Now, you might want to build a little bit more safety than I am. I'm putting a 9% buffer in there, 9% rate of return, and they also pay nearly a 3% dividend. So my overall rate of return is going to be closer to 12% here with dividends reinvested. If I'm looking at that as my jumping off point here. I'm basically looking at trying to buy the stock between $24 and $25. From a free cash flow standpoint here, if they get margins back under control and this company starts free cash flowing closer to $1 billion a share, we can definitely be paying closer to $30 a share on the stock. So I'm very comfortable between that I'm very comfortable between that $24 to call it $27 range. And that's basically where the company's sitting right now. Obviously, with the recent market rally here, it's been a little euphoric, but I definitely think it's sitting in some fair market value here, especially if you think they can execute. As I stated, I think this company's dealt with a tremendous amount of headwinds. The price is kind of baked into that, but the tailwinds that are coming, I think, are not being baked in. Now, I could be completely wrong here. Commodities are very, very hard to judge, but I think they're positioned extremely well. And when we look at most experts, a lot of people think between a $30 to $34 price target is appropriate. We have 1 sell rating, 6 holds, 3 buys, and 1 strong buy. I'd say overall it's a pretty neutral rating, not a tremendous amount of coverage on this stock, and that's the type of stocks that I like, is when people are throwing in the towel on them, that's when you want to be looking at them. And that's how we found companies like Sprouts Farmer Market. We found PayPal when it was trading at $55 a share. And this has kind of been my thesis on Pfizer here, is if we see a spike come back in COVID and people start getting concerned, new vaccines are rolling out, COVID and Moderna are ahead of that game still, that would be a tailwind that's the market's not seeing anymore. They're basically writing off all of COVID at this point in time, but we're starting to see as of July that COVID concerns are now starting to pick back up, which is a good signal for both Moderna and for Pfizer. Now, for Pfizer, like it way better than Moderna long term. The acquisition of Seagen, they got a lot of different things coming through their pipeline. So if something did outbreak when it comes to COVID, I think you're getting a lot out of Pfizer, and it's very, very undervalued. Historically, you're looking at 13.5 times earnings. If we go off of what they're projected to do for earnings here, not including this year, but if we look at 2025 earnings and we're seeing that they could be earning close to $2.75, I'm actually going to undershoot this by a little bit just to build some safety. And let's just say they earn $2.60 and we put a 13.5 multiple on that. You're basically looking at a $35 stock, and that's not including the 5.85% dividend yield that you're getting. So if we think about that, this could be a 28, 29, maybe even a 30% rate of return, and that's really not including anything that could possibly pick back up when it comes to the COVID side of their business. So, I think if you're looking at this company longer term and you can get back in at the $25, $26 range and get nearly a 6.1, 6.2% dividend yield, you really don't need a tremendous amount of equity return to really outperform the market, historical market returns here. So this one's still pretty interesting to me at these levels. I would definitely be looking for a pullback, but it could be having a catalyst here now that there's these updated vaccines coming both for Pfizer and Moderna that's approved by the FDA. And if we get some sort of scare and we get a spike in COVID vaccinations needed, then, I think this is going to be a nice possible earnings report for Pfizer that was pretty much unexpected at this point in time. As always, guys, this is just my opinion. Hopefully you enjoyed, and we will see you in the next one.